Hi guys, welcome back. So Broadcom just pulled off something pretty insane. 116% total return in just 1 year and close to 1000 in 5. That's not a win, that's a flex. And after 3 record quarters, custom AI chip dominance and partnerships with hyperscalers like Meta and Google, they have a lot going for them. But their biggest strength, a bold and acquisition-fueled growth, is now threatening to become a liability. Because their biggest acquisition so far is facing intense backlash. And by the end of this video, you will understand their business strategy, where their financials stand, and why even top analysts can't agree on where this stock is going next. And if you're new here, my name is Florian. Thank you for joining me today. Over the past 12 months, Broadcom delivered a staggering 116% total returns and vastly outperformed the S&P 500 that made 19% over the same time. And over the last 5 years, the picture just gets better. Because during this time, they made almost 1000% compared to the 115% of the index. So if you would have invested in them only 5 years ago, you would already almost have a 10-bagger in your hands. This top performance was driven by very strong recent sales of their custom-made AI chips or XPUs and other related AI hardware like high-speed networking products that are used in data centers. With this, they just closed their 3rd record quarter in terms of revenue in a row. We will talk about the details and what this means for Broadcom in a minute. But let's have a very quick look at what exactly they do first. Broadcom, with the ticker symbol AVGO, is a California-based tech company. What is special about them is that their business is split between infrastructure software solutions that make up around 40% of their revenue and semiconductor solutions with 60%. These products are sometimes not sold under the Broadcom name, but under their individual brands, especially in the software segment. For example, in the cybersecurity category, they own the Symantec brand, in enterprise software CA Technologies, and in private cloud VMware. This comes from their long and pretty successful history of growing through acquisitions. Because Broadcom is known for buying businesses, streamline their operations, and generate value by doing so. For these acquisitions, they tend to focus on mature businesses that are already generating a healthy cash flow so that they can immediately start boosting their own cash flow. The last major one so far was the acquisition of VMware in 2023. Unfortunately, this turned messy pretty quickly and might have been a big mistake. Because this operational streamlining and cost saving that is an essential part of their acquisition strategy and has been successful in the past might actually backfire in this case. The market research agency Gartner even estimates that Broadcom might lose 35% of workloads in the next 3 years. There are a plethora of reasons for this, and it goes beyond the scope of this video to go over all of them. But let me give you a brief summary. First, customers of VMware have experienced dramatic price hikes. And we are not talking about a couple $100 here. Toshiba, for example, experienced a price increase of 10 times since Broadcom took over. And keep in mind that large companies like them don't just buy one license. In their case, it's even well over 2,000 virtual machines after they have been customer of VMware for 16 years. And it's not only the price alone that gets more expensive. No, Broadcom also forces their users to buy streamlined bundles now that often includes products that the customers don't need. But they still have to pay for them regardless. And this comes at the same time as the support quality deteriorates quickly, with customers reporting longer response times and less experienced support engineers. This is hardly surprising when we consider that Broadcom has already reduced VMware's workforce by half since the acquisition. And the effects of this reduction are not only felt in the quality of the support, but also the lack of innovation. While VMware invested heavily in R&D before the acquisition, Broadcom's playbook is renewing existing enterprises instead of bringing new products and new customers, as Hock Tan, Broadcom's CEO, said himself in the past. And this also fits the very recent decision of Broadcom to not proceed with the typical cloud providers and hyperscalers as strategic partners, as they have been in the past. Yes, this can boost their revenue in the short term, but can also make it more difficult for them to acquire new customers in the future. I'll leave a link to this article that covers even more points in quite some detail in the description below if you want to dig a bit deeper into this. Now, you might say that this is only a small part of their diversified business, and you are correct. Unfortunately, Broadcom does not report individual numbers for each of their brands. So we don't know exactly how big the part of VMware's revenue is for Broadcom's total revenue. But when we compare the software business before the VMware purchase to the one after and do some napkin math, we can assume that VMware made up more than 20% of their total revenue, at least in the last quarter. So losing this business, or even part of it, would have a severe impact on their financials. But enough of the negativity. I promised you earlier that we'll have a deeper look into Broadcom's AI business. So let's do exactly this. And first, let me explain what exactly Broadcom does here. And I really hope it doesn't get too technical. As I'm working in the semiconductor industry myself, I tend to get carried away on such topics. So I will try to be brief. Broadcom is a custom ASIC provider. So they design custom chips, like for example AI accelerators or XPUs as they call them, for their customers. This includes many different technologies like the core of the chip, the processing unit, that can leverage a lot of their know-how and IPs. They usually co-design this compute die with their customers. Then they can also provide the design for the HBM, the high bandwidth memory chips, and the integration of these, which is also not trivial because of the limited space and interconnection area with the compute chip. They can also provide the full chiplet-based network I/O, including high-speed Ethernet, which is supported by their own hardware and firmware. This is actually one of the biggest strengths that Broadcom has in my point of view. Because AI networks, not only on each chip, but also between chips, racks, and even different data centers, needs a huge bandwidth and uptime. And the latest Tomahawk switches that connect GPUs or XPUs inside an AI cluster, and the Jericho 4 switches that act like a traffic controller in very large networks between thousands of AI chips, they have high-end products that are also used outside of these chips and are necessary for basically every state-of-the-art data center. And in the end, Broadcom also has all the relevant technologies in advanced packaging, including silicon photonics, which gives them a huge advantage in building power-efficient and high-throughput AI systems. So they are not relying on one single technology, but rather a whole range of designs and IPs, which gives them a unique position that is not easy to replicate. And while Nvidia's GPUs are still the default choice, big hyperscalers like Google, Meta, and Amazon are all rumored to work with Broadcom on their custom chips. And the expectation is that this will further increase the AI semiconductor revenue from 5.2 billion in Q3 to 6.2 billion in Q4. Some analysts even think that their new Jericho 4 switches that I just mentioned could reshape the design for AI data centers because it enables interconnects over more than 100 kilometers, which allows a larger distance between the compute chips. The market for all these data center networking products is also expected to grow with a CAGR of 13% until 2032. And this is not the only quickly growing market that they are active in. The data center chip market could grow even quicker with 15% annually, and custom chips like ASICs are playing a big role here. And even the market for virtualization software like their VMware is expected to grow by over 15% per year. But here, I think that Broadcom will have a hard time to keep up with this market growth. There is just too much going in the wrong direction right now. So, now that we covered their business and the macro trends, let's get into the hard numbers. The revenue, EBITDA, and free cash flow did grow very nicely and steadily in the last years. And the growth numbers all across the board are pretty insane. But we need to keep in mind that this was not only organically, but also included the growth from the many acquisitions that Broadcom did. This also resulted in some one-time effects like tax provisions or integration costs from the VMware acquisition, which lowered the EPS numbers and the net income. But because these were one-time effects, there is nothing to worry about. And for the first time, I'll be using my own quant model to break down these numbers and rate them. I have built this model based on research and statistics of what works best when predicting a stock's performance over the better half of the last 1.5 years. It is meant to give an objective view on the numbers and rank companies across 5 categories and over 30 different parameters. I will also make a video where I go over it and explain how it works in the next few weeks. So if you are not subscribed yet, Now is a very good time to do so to not miss this. So first, let's look at the growth category. Here we see the CAGR numbers for revenue, free cash flow and EPS for the last 5 and 10 years, each ranked with individual scores between 1 and 10. We also see the 3-year EPS and revenue forecast here on the right hand side. And except the 5-year free cash flow growth, Broadcom has a clean 10 score in all of these metrics. This results in a 5-year growth score of 9.88 out of 10 and a 10-year score of 9.9. Please ignore the small number behind the score for now. This is the ranking between all companies that I have rated so far, but because the final version of this dashboard was just released, I have only rated a dozen companies or so far. The financial health and profitability picture is a bit more mixed though. They do have a long-term debt to EBITDA ratio of 1.6 times right now, with an interest coverage of 3.8 times. This is not bad, but also not great. And unfortunately, they have also issued quite some shares in the last 5 years, which has brought the share dilution to 3.5%. But they also authorized a $10 billion stock buyback program in April that is running until the end of the year and should change this trend. It is also not the first time that they have done this. The margins do look quite good and are generally going up. We can also see some effects from the last acquisition in 2024 here, but I think that this should also turn again when we have the final numbers for the currently running year. So for the margins, they get quite good scores again. We have 9 points for gross margin and a clean 10 for EBITDA and free cash flow margin. Only the return of invested capital just gets 4 points. Overall, this leaves a 5-year and 10-year score of 6.8. Broadcom is also paying a dividend with a small yield of 0.66%. But they could grow this with an impressive 13% annually over the last 5 years and still keep the cash flow payout ratio at a reasonably 50%. And they could also grow this for 14 years in a row by now. This leaves them with a 5-year score of 6.7 and a 10-year score of 7.3. The quality score includes things like the moat, the secular trend, cyclicality of the business, but also their customer concentration and the manager quality that I measure with the return of invested capital and the general capital allocation strategy of the company. Here, they get an average score of 6.5 for 5 and also for 10 years. What hurts them a bit is the low ROIC and the high customer concentration with their custom chips. But at least they have a very decent moat and a strong secular growth in their back. The last category is the valuation and momentum category. Here, they have a very strong momentum on one side, but that comes with a similar high valuation on the other. Overall, they get only a 5.6 score for 5 years and a 4 for 10 years. The PEG ratio on a trailing 12-month basis looks very good here, but I want to mention that the forward PEG for the next year is more than 4 times as high. Something to keep in mind as well. This valuation is also pretty high when we compare it to their own history, and we can also see that it has recently increased by quite a bit. So a good portion from the great stock performance actually just came from an increase in valuation. Overall, this gives us a 5-year score of 7.06 and a 10-year score that just narrowly misses the 7. This is definitely not bad, but from the companies that I have ranked so far, and that I all have in my portfolio already, this is roughly in the middle of the pack and below other tech companies like Nvidia, Microsoft, Google or even Meta. The company still gets a strong buy from analysts, but the opinions about the 1-year price target are going apart quite a bit. While the 39 analysts still see an average upside of 9.3%, the maximum upside they see is roughly the same as the maximum downside, with around 21 to 23% on either side. And before I sum this up and come to my conclusion, let's also compare them to some of their closest peers. And or actually Seeking Alpha in this case, choose TSMC, Micron Technology, ARM Holdings, Texas Instruments and Nvidia. And of course, from this group, Nvidia had by far the best performance. In fact, they play so far in their own league that all the other companies are barely distinguishable from one another down there. But Broadcom still comes in at second place with 3,400% total returns. From a dividend point of view, Texas Instruments has the highest yield. The highest growth in the last 5 years has Nvidia, but their yield is so small that this almost feels unfair. So let's just say that Broadcom has the highest growth from all the real dividend payers. The payout ratio is pretty low for all except Texas Instruments that are currently in a huge capex cycle. The valuations in this group are very mixed, with ARM and Broadcom leading the pack. Even Nvidia is quite a bit cheaper than these two. And this despite they haven't had by far the highest growth in this group. But in general, all of these companies except Texas Instruments are growing very nicely. It's a good thing that I own Texas Instruments then. Well, someone needs to bet on the underdog, right? When I first invested in TI 3 years ago, I actually debated whether to put my money in Texas Instruments or Broadcom. Well, now it's clear that I definitely made the wrong decision here. I do like the business mix from Broadcom and the capex-light semiconductor business model that focuses on chip design and not production a lot, especially with their strong position in custom AI chips. But in general, I am not a big fan when a company grows primarily through acquisitions, even if they have a good system and a proven track record. And the discussions that are currently going on around VMware are showing the risks with this strategy. Now, the last word has of course not been spoken yet, and it is a long way from a complaint to an action. But the issues are mounting and it doesn't look too good right now. My main issue, however, is the very high valuation that seemingly went a bit overboard lately. There is a lot of optimism baked into the stock right now. Maybe even too much. And my stock rating seems to confirm this because it also places AVGO behind companies like TSMC, Nvidia, Microsoft or Google. If you already own the stock, congratulations, you made a great investment. But if you don't, I would wait for the valuations to come down to more reasonable levels again. But as always, that's just how I see it. What do you think about Broadcom, and did you get in time? And guys, if you're interested in another insane dividend grower that just got huge catalysts from the US government that could drive its growth for a year to come, check out this video about S&P Global. And of course, this is no financial advice, so please, before investing, do your own research and only use this video as a starting point for your own analysis. That being said, thank you so much for watching guys, and see you in the next video.